Hello, Mark Sturdy here with another brief survey of the high points of our analysis this week of major world markets, and you will see that we remain strongly bearish of the dollar against the euro. We are bullish of the S&P and the Nikkei 225 still in all time frames, and we are newly interested in the fate of the German and UK bond market. We think yields are going up and prices are going down. Let's have a look at the dollar euro to begin with. Long-standing situation here of, we think, a weakening dollar against the euro. Attempts to strengthen the dollar, 1, 2, 3, to get down between 114 and 73 have failed. It's not terribly exciting on the upside yet, but such is the powerful support that we're happy for the euro, we think, to continue strengthening. Short term, the euro has weakened, maybe a small double top, not quite perfect since these aren't level. However, the breakdown through this prior load suggests maybe approach down to 114. This is all short term. Long term, we think the euro goes better. Dollar sterling had a bit of a wobble, but you can see that in the context of the last few months, indeed years, it's within a very well established trading range against the dollar. Here's the wobble, but here's the trading range. There's the wobble. Obviously, we think it might go down a bit further, down to 131 or so. I'd be surprised if it breaks the trading range. Very quickly, sterling euro does beg the question, what has sterling wobbles done to that? Here's the trading range of sterling euro. Here is the trading range there. We're in the middle. Stand back. We remain bulls of the S&P 500. There's the long rally from 2009. Here's the medium-term break-up through 70.14, the recent highs. The market accelerated fiercely after that. Here it is in more detail. Perfectly reasonable it might want to come back, having done such a very quick acceleration. It all looks good, we think still, broadly speaking, in anything other than the very short term. Look at the Nikkei 225, tremendous underlying structure to the breakup through 39,600 some while ago. The market has marched on. Attempts to pull back have failed, bouncing back off the prior highs, as we think might happen still here if the market continues down in the very short term. These are good supports. Watch them carefully, but until they break, the market is bullish. Not quite so bullish here in the Euro stocks. Market's been going sideways within a trading range. Having broken up through this, attempted to break back once before, it's still going sideways and looks rather more vulnerable than the Japan and America because of that long sideways transition. So too the FTSE, a similar sideways trading range. It even may have broken the prior low this morning, 101.63, possibly coming down further. Watch for a break of 99.62 to revisit this in terms of whether we go bearish. The new news is that these bond markets are very bearish, price-wise, bullish, yield-wise. The T-note remains in the trading range. Short term, it has got weaker, broken down through prior lows. This is pushing up to the top of a trading range. We'll be watching as chartists for a break of this trading range if it happens. Above 4.8 would be exciting, and it might well have a go at it with this price falling as fast as it is. The real drama lies in the German Bund. Long-standing break-up through resistance at 294, 299. The market wants to go higher, we think. And in price terms, we've just completed, short-term price terms, we've just completed a continuation triangle, suggesting the market drops at least down to 22, to 2 or 3 big figures on the downside in the very short term. So we think long and short term, it is bearish for prices, bullish for yields, and particularly the UK gilt. We've long looked at this continuation triangle. We've been thwarted in our bearishness by the sideways price action throughout 2025. Now that's broken down again, and now we've got fresh structures coming into play, having completed this continuation triangle in terms of yields. We think this moves up to 6.2 or so minimum, quite a move from 5.2. That's a full percentage point in the 10-year. Shorter term, we see the completion of a Head and Shoulders continuation pattern driving prices on down, and here's an even smaller Head and Shoulders driving yields up. very bearish. So we are newly bearish of the bunds and the gilts, not doing much in the oil. It's yet to break this trading range, and nor are we excited by gold until these supports beneath gold, having driven up so far and so fast. We're watching these supports and seeing how it reacted. It's already bounced 1, 2, 3 times off 43.98 in the weekly continuation chart. 1, 2, 3 times. It's reapproaching it again. Were that to break in a convincing manner, we would be bearish of gold, but not yet. Thank you very much.